All right. Yeah, I can just kick us off and then we go into our intros. All right, so welcome to lecture 9 or 10 now. We're learning about decentralized finance, often abbreviated as DeFi, and that's how we'll refer to it from now on. And yeah, let's just get right into it. We're going to give you a big old overview of what DeFi means. You might have already heard a lot about DeFi already, but we are here to give you our perspective. But yeah, you can go to the next slide. So I can start with an intro. I'm Nishan. That's my weird anime looking profile pic that I made. I am one of the co-presidents of blockchain at Berkeley, also a massive DeFi stan. I kind of got into DeFi last summer during this monumental series of just events that happened called DeFi Summer. And I had a lot of fun talking to a lot of blockchain at Berkeley members about it. And that has led to me where I am. I help around with a lot of the DeFi governance stuff that we do in blockchain at Berkeley. So I'm totally down to chat about things like that. But yeah, Omkar, you.
Hey everyone, my name is Omkar. I'm actually a BAB grad. Thanks everyone for having me back. It's nice to be back. I was a member of the education team on BAB for a couple of years, and I've taught this class many times. I've been an admin. I think it's one of our most important initiatives, and it's nice to be back. I was part of the accelerator with Nish, and actually last summer during DeFi summer, as Nish referred to it, I was working for a crypto journalism company, so it was nice to have like that perspective while things are going crazy. But yeah, excited to be here. And a little confession that I have to make: I am an old man. Most of the time that I've taught this class were in person, so I may commit some like online faux pas, like asking rhetorical questions or looking for responses where there may be none. But yeah, I mean, do your best to put up with me, and let's have fun with this one. Go ahead, Nish.
I love it. Yeah, that was perfect. Let's get right into it. All right, let's see what's next. Omkar, you got the next slide? All right, we're gonna start with a little bit of a intro and reaction to what you might have heard about DeFi. So we go to the next slide. And we'd like to start off this lecture by just asking ourselves, what even is DeFi? Has anyone heard of it before at all? You can hit me with something in the chat. And if you have, what does DeFi mean, or what is something about DeFi that you've heard of? Brian, I'm going to ask you to hit the chat up if we don't hear anything else, but I'd like to hear what anyone has heard. Ooh, what have you heard, Ryder? Yeah, that's a pretty good general theme, and we're gonna hit on that. Very cool. All right, we can just get into it. So when you ask yourself, or if you ask someone what DeFi is, or if you just search it up online, you might run into many things. You might run into a bunch of scary big numbers like here about, okay, percent returns, or a bunch of logos, really weird logos, and a bunch of food-based DeFi protocols. You might also get a little bit overwhelmed with how much there is around there, because you will run into hundreds of projects that call themselves DeFi companies. So it can be a little overwhelming at first. But then if we go into the next slide, is it this, or is it this? Another thing you've heard or may have heard about DeFi is that it's a scary place. Maybe at some point last year, there was 8 weeks where you couldn't go a week without a major DeFi hack. Things like the harvest finance attack there on the left. Oh, a rotten harvest, another DeFi farm is spoiled. Or we hear about these things called flash loan attacks, or perhaps more infamously, Black Thursday, which we'll learn a little bit more about. These are all events on the DeFi timeline, and they can scare people a little bit because to some people, as it seems in the headline on the bottom left, another day, another DeFi exploit, this is regular. So is this DeFi? Is what we want DeFi to be? Let's help dispel this a little bit as we go to the next slide, Car. And we kind of ask ourselves, what is DeFi really? Without the fluff or speculation or degeneracy as a common qualifier here. To many, DeFi is the movement to build an open, global, and interconnected financial system without the drawbacks of traditional finance we've discussed. So we've hit on several, but another really awesome, motivating story simply from this year, 2021, was the whole Robinhood thing, where, okay, GameStop was doing its thing, and like casual retail traders like you and me were like, okay, let's get into it. I want to trade GameStop. And Robinhood, along with many others, straight up just said, no, you can't do that. I'm not going to allow you to do that. Who knows what kind of crazy backroom under the table dealings were happening to do this. But the point is that people weren't allowed to exercise their free will in this way and trade the way that they wanted. And that, I think, is one of the most very, very defiant and certain reasons for why we need DeFi. In something like DeFi, we have an open financial system where you are not stopped by any authorities, by any central authorities who are here to change or manipulate or control the way that you trade, which I think is really awesome. We're going to go over a bunch of pillars and fundamentals of DeFi over the next few sections, but that is a very simple, motivating experience. So DeFi, if we get into it, we think about the second word, DeFi, finance. And finance is a little more complicated than just currencies. We have cryptocurrencies already, which are great, but what else can we do with these cryptocurrencies? And financial systems and financial products are the kind of answer to that. These complex trading platforms or lending platforms, et cetera, which we'll all get into, are what comprise DeFi. DeFi is all about, financial applications and power to the people, as I like to call it. So DeFi on a concrete level are often applications built on smart contract blockchains like Ethereum. So Ethereum smart contracts are the mode that most DeFi applications right now are deployed on. And DeFi is also continuously developing. It, to many people right now, is in a very experimental phase. We're only in the first few years of figuring out what DeFi means. So right now, to many people, it's an experiment that has a lot of room for growth. So it's a very exciting place to be around. Shervin, I saw your little question about L2 exchanges. I can kind of hit on some of my favorites there in the decentralized exchange section, because I'll kind of talk a little bit there. But yeah, I have a few fans. I actually messed around with Loopring in the past, and it was pretty mind-blowing to see my transaction fee not be like $300. But we'll get into all of this very soon. But I hope the general motivations for DeFi are a little clearer. On the next slide, I have another sort of motivating example, and that is highlighting the decentralized part of decentralized finance. When you think about it and you ask yourself, is every blockchain-based financial tool decentralized? No, not exactly. And let's take something like Coinbase. If I hold a Bitcoin and I go to Coinbase and I'm like, hey, I have Bitcoin, it's also my Coinbase wallet, I would like to swap it for ETH. And if I need to do that, I send Coinbase over my Bitcoin. They do whatever they want and give me back my ETH. And this is weird in a little few ways. You're really truly trusting Coinbase with your money in this. You could give them your Bitcoin and they could do whatever they want with it. They can quote whatever price they want with it. And in the end, it doesn't really mean much. All they have really at stake from hurting you is just their reputation. So say, what if Coinbase gets breached? You're absolutely screwed. And what we want is decentralized platforms where what you see where basically you know exactly what to expect, because a lot of these applications are on these smart contracts where you see either logic fully mapped out, or you know exactly what calls are going to be made, and things are very properly audited in public, which is pretty awesome. Yeah, and that's pretty much what I wanted to highlight here. Omkar, is there anything else you wanted to mention before we take a few questions? I
Nothing
think
from
we're
my
all
side.
right. Yeah. I was just wondering if you had anything to add, but we can pause for a minute for questions just to make sure this is sort of sinking in this why DeFi and at a very high level, what is DeFi? So hit us with any questions, please. We are here for you.
I have a quick question about Zoom stuff. If I open the chat here, can you see me doing that?
Nope, thankfully not.
Cool. Okay, because
Yeah.
it's on the same screen. Okay, perfect. I was
Perfect.
refraining
Yeah.
from seeing the chat and I couldn't see any of the questions.
No worries. Yeah. That's a good point. I always get scared of something like that.
Right.
All right, we can kind of continue on, and we will continue on by chatting about some of these, in our eyes, pillars of DeFi. Because now we've kind of mentioned the motivations behind something like DeFi, but I think it's really useful to just go into it and see, like, okay, let's just break down all these barriers. What is DeFi? Give me the sauce. So we split it up into around 6 sections, and I'll take the first half, and then Omkar will take us away from there. And we're going to start with stablecoins. So we can move on to that. And let's talk about stablecoins. In the next slide, I have a kind of start for us. We've likely heard of stablecoins before, but I just wanted to start with a little bit of context again, kind of asking, okay, why do we need stablecoins? And in the end, what are stablecoins? And when you chat to someone about cryptocurrency, perhaps you were chatting with someone about Bitcoin because you learned about it in this class. A lot of times people's first complaint when you mention cryptocurrency as a solution to something, as a response to our current centralized financial systems, very often a first complaint is the volatility of cryptocurrencies. And if I want a currency that maintains a stable value, I don't necessarily want to see the graph that I'm seeing right there for Bitcoin's price. It's a little worrying if we think about purely monetary stability. And then stable coins are kind of a response to this. I think it's pretty obvious from the, the name itself, but the goal of a stable coin is to be a cryptocurrency that maintains a stable value, oftentimes currently chosen as one USD to make it very easy and understandable. So there are many types of stablecoins. I'll kind of highlight 2. The first I'll very quickly brush on is these stablecoins that are fiat backed and often sort of centralized. So this means that in order to generate or mint this stablecoin, you have to drop down a certain amount, often an equal amount of fiat currency, so dollars or euros or pounds. And what you'll do is you'll go to one of these portals and you'll drop down your fiat money, and then an institution often. So for something like USDC, the Circle institution, or USDT, the Tether organization, will then issue you this stable coin. And because they're issued by these organizations, while they still are stable coins, a little bit of their own functionality is controlled by these organizations themselves. They're a very strong stablecoin, but it's because they have this little bit of centralization to it as well, where these organizations can maintain these pegs very, very sharply, which is a little worrying. So we have these fiat-backed, slightly centralized stablecoins, which are still pretty rampant around DeFi right now, but the proper wave and the things that people really get excited about are crypto-backed, decentralized stablecoins. So now you're no longer even using fiat currencies to generate your stablecoin. You're just using cryptocurrencies themselves to create stablecoins that can't be controlled by institution in the ways that we've seen these other fiat-backed stablecoins. So very quickly, I think you can guess which one we care about developing more in the long term. These cool decentralized stablecoins. And so we can go to the next slide. Let me quickly get my laptop. And we're going to talk about and dive into the ultimate decentralized stablecoin right now, which is Dai. And the premise of Dai is we have this goal to create a stablecoin, and we need to do this using cryptocurrencies. How do we do that if these cryptocurrencies that we're going to use as collateral to generate our stablecoin are volatile themselves? Well, their solution was, okay, let's over collateralize right now. Let's put in more volatile crypto into this vault to generate the stablecoin. than the stablecoin that you get out. So we have a collateralization ratio. And this is a term that I'm going to mention a little bit, but it's sort of the, okay, what percentage or what ratio of collateral do you need to get an X amount of stablecoin back. So I'll kind of give an example of this in a little bit to see the numbers. And the immediate reaction to something like this, thinking about over collateralization, is why would I do this? Why would I put more money into this vault? I'm just keeping that there. Why wouldn't I just use that cryptocurrency, the little more volatile cryptocurrency? But there is value in having a stable currency itself. It's already proving itself around other DeFi products, where having a stable currency to deposit into X, wherever, is more lucrative for you. But even in general, there's a price to stability. And right here, that price to stability is this over collateralization. And many people see value in that. So it's enough to be worth it. But now let's kind of see how this works in actuality with Dai itself. And I have a little diagram here, yeah. So to kind of explain how Dai works, we'll look at it like this. We have me on the left, and I have around $150 in ETH, and I want Dai. Please give me Dai. And then this little building in the middle, we'll call that the Dai smart contract. So these are smart contracts on a blockchain, and I'm making this call saying, hey, I have ETH. Can you generate Dai for me? And if I have $150 worth of ETH, and we're going to work in dollars for this, for simplicity, if I give you $150 in ETH at a collateralization ratio of 150%, meaning to get X amount of Dai, you have to pay 1.5 times that in your collateral, I will then get 100 Dai back. And this is almost like the Dai smart contract is loaning this out to me, with me then placing these Ether as collateral. And what I have now is this Dai and an outstanding loan. And I have this debt to the smart contract. And eventually, when I'm done doing whatever I want with my Dai, I need to give it back to the Dai smart contract in order to get my collateral back. And there you go. You've done what you want to do. Perhaps you made a little bit more money. Hopefully you did. Hopefully you gained more value from collateralizing and getting Dai back, to then give it back, be cool, you close your position, you get your collateral back. So that's how that works on a very simple level. But then in the next slide, we'll kind of ask ourselves, is it really that simple? And I've given this flow of, okay, generate Dai, I have this Dai, I give it back, I get my ETH. Is that it? But let's talk about the risks here. So the big risk here is the volatility of the collateral that you put in. When you have these volatile cryptocurrencies that you're using to collateralize your Dai, there's always the chance that the amount of ETH you put in, say, drops in value such that it is worth less than 150% of the Dai that you borrowed. And that there is a fragile position, because the value of Dai isn't stable right now. It's not being backed by how much it expects to be backed by. And the response that the Dai smart contracts do to this is doing something called a liquidation. So I won't go into the entire process of what a liquidation looks like. I would totally recommend you read into something like the Maker white paper, which is totally at your guys' reading level right now in terms of blockchain knowledge. And what happens is the Dai contracts will do everything to get that Dai back into the system, because that's what the debt is right now. You owe them Dai and they need to get it back at any cost. So what do they have? They have your collateral already. What they're going to do is then sell your collateral to others for Dai. And in the end, because you are over collateralizing, you might not lose all your money, but you will lose that $100 worth of your collateral, and it's gone because you did not manage your position properly, is the stance of the Dai contracts. There are many others fail-safes, but liquidations are the kind of main one and main response to the volatility of cryptocurrencies and how they can change stablecoin positions. But yeah, that is liquidations. We can go to the next slide. I think that might be it for this. Yeah, and we'll pause for questions on stablecoins. And y'all can unmute at any point as well with questions. I'm totally cool with just making this conversation together, talking about DeFi and trying to understand this wild concept together. How's this sitting in your head, Brian? Wanna get a bit
I have a question.
let's hear it.
How can you go over again why you would want to like in your example you like paid $150 in ETH to generate
Yeah.
100 Dai? Like why would you what's the why would you do that?
Yeah, I got you. So generally in the case of something like generating Dai, I'll be very practical in my kind of answer so that very very much just like makes a lot of sense to you in terms of an example. And so when you're out there in this decentralized financial system, a lot of times you'll notice on these platforms where right now you are looking for the best way to invest your money. A lot of times these DeFi platforms will value you giving them Dai in some way, you using Dai to invest, such that it's actually way more lucrative to use Dai as your financial primitive when depositing into other DeFi smart contracts than something else like ETH, because they value that stability in doing all sorts of trading and robot trading by things like that. And so a very common case is, I have this collateral and I generate Dai, and then I do some sort of trade with it. I either deposit into another contract to do trades for me, or I do things myself. And in the end, you'll be making more with that Dai than you would have with your ETH, is basically the choice in the end. So people see value in doing that. Is a very classic example of why you would generate Dai. Yeah, does that make sense, Brian?
Okay, so it's kind of like an investment.
Yeah. It's a very financial decision. Yeah, Omkar, yeah.
I was gonna say, you can also think of it sometimes as a loan with collateral. What some people want to do is they want to put, like, if you have crypto maximalists, they want to put all of their money in crypto and they don't want to sell like a single bit of it. So now let's say you have a bunch of ETH, but you need money to like do the groceries, or you need money to do something. You still want exposure to your ETH, right? If ETH moons tomorrow, like ETH price goes really high tomorrow, you don't want to have to sell your ETH before that and lose a bunch of value. So you're like, okay, what if I just lock away my ETH and then just get a bunch of Dai and then use that to do stuff? So it's almost like having access to capital to do stuff while still maintaining your exposure to the underlying asset that you want to maintain exposure to. So that's another usage of being able to mint Dai with USD with ETH, even though it's over collateralized. I see some other interesting questions in the chat. I think Ryder asked, if ETH or whatever collateral you're using spikes in value, then will the Dai contract give you some back? I don't know if it automatically gives you any back, Nish, correct me if I'm wrong, but I do believe what does happen is what you have to do is maintain your collateralization ratio, right? So if, oops, sorry about that. So if, let's say ETH, or like one ETH is $150 and you've withdrawn like 100 Dai because of the overall the collateralization ratio of 150, and then ETH tomorrow spikes to $300, right? Doubles in price. I think what you might be allowed to do is either get 100 more Dai, because that's still within your collateralization ratio, or withdraw half of your ETH. Obviously that may change your example, or that may change your likelihood of getting liquidated if you do decide to do that. But I think that's what you're allowed to do. Correct me if I'm wrong, Nish.
No, yeah, you're pretty much spot on. Like, if your collateral spikes in value, that's totally cool, and that's just good for you. You don't get anything back immediately, like you don't get more Dai, even though it's worth more. Or you don't
nothing
get any
happens
more
automatically. Yeah.
ETH. But it does mean that your ratio is higher, so you're safer. Yeah. Good question.
Did Shervin want to talk about Terra USD, or was he just or were they just bringing that up?
I'm not too sure. Terra is a really cool app though, and just another way you can generate yields, and another reason why you might want something like a stable cryptocurrency to use like that.
Yeah, they basically use another token, the Luna token, which they arbitrage between their stable coin to maintain their peg. It's a very interesting project, gained a lot of traction very recently.
Yeah.
Yeah, we can move on.
Yeah, I feel like we're ready.
Let's do it.
Very cool. So next we're going to talk about DEXes for a little bit, which are decentralized exchanges. So another fun acronym, DEX, decentralized exchange. But yeah, let's get into it. So once again, the what and why of DEXes. It's a very clear use case to have something like a decentralized exchange. But we'll split it up into two parts. So first off, why do we need exchanges for cryptocurrencies? This one's pretty obvious. I mean, with so many cryptocurrencies out there, how do you go from A to B in terms of the cryptocurrency? If I have ETH and I want to get something like Dai, okay, do I have to, what do I do? Do I have to like only go through maker contracts and generate there? Is there another way to get it? And very much like how you see with stuff like foreign exchange trading, forex trading, you have exchanges to go between different cryptocurrencies, like you might between the pound and the dollar. Why decentralized? Now this goes into the Coinbase example. Remember when we had Coinbase where we could have Coinbase execute trades for us, but it would just be this little black box that we really wouldn't know what was happening around. And the people at Coinbase could make decisions to completely change the way that my trading experience was. We want to give power to the people and to the markets by having everything executed on these public smart contracts. And that is where the decentralized manner comes into it. DEXs come in all shapes and sizes, but I'll kind of choose two general categories of DEXs to highlight. So first off is the order book DEX. This will harken back to how you know exchanges just in the real world, the centralized finance world. This is where, okay, there are open orders on the market. There are the kind of many different terminologies, but there's like the maker orders and the taker orders, where there are people who are like, okay, I want to buy a currency for X, and someone else saying, okay, I want to sell X amount of currency for X, and then they kind of match up together using a little algorithm. But another really cool sort of exchange is the automated market maker. This is a new sort of exchange system that has become very popular in DeFi right now. And it is something that I'm going to focus on for the next few slides. So let's get into what AMMs are. We can go into the next one. And here's what it is. So automated market makers mean that the price that you are quoted and get for making a trade is fully based off a function of the supply in these liquidity pools. So that's a lot. But let's start with this liquidity pool concept. Rather than having orders and a list of orders to create this order book, why don't we use a pool of liquidity where we have all the suppliers supplying their cryptocurrency together into a pool? And then why don't we go in and out of that pool rather than matching particular orders? So there are a few distinct advantages to using liquidity pools and then having function-based market makers for us. What's really awesome is it handles low liquidity situations, and that's great because when we're working with things like cryptocurrencies, volume and liquidity are very, very volatile factors. Because in something like an order book method, when you have low liquidity, you have also a low amount of orders, a low amount of kind of takers on your orders. And when you have that, it's kind of unideal, and slippage becomes very high. Slippage is kind of the difference between the price that you are being quoted and the price that the trade eventually executes at. But AMMs are very adaptable, handle these very nice low liquidity situations. And in the very fast moving world of crypto right now, are very useful. So let's say we have a pool for trading Ethereum and Dai together. So we have this ETH Dai pool. So how do we get a price for this? And oftentimes the method that people go for are these constant product functions, x times y equals k. And okay, interesting, where we have this function where x and y are the supplies of the cryptocurrencies in the pool themselves, this paired pool. Okay, let's see how this works. And we're going to go through the lens of something like Uniswap, a very awesome decentralized exchange, one of the first decentralized exchanges. And we'll look into how Uniswap uses this constant product function to quote people and execute trades. So on the next slide, we kind of see this in action. So I'm going to go through a nice little example. In our pool, we are swapping between bananas and apples, apples and bananas. And in here, apples will be our X and bananas will be our Y. And the X and Y here are numbers, so supply numbers. So we have 50 apples and 50 bananas. So K is 2,500. If I want 10 apples, okay, I know that I'm gonna have to put in some amount of bananas in order to get 10 apples out. And the way the constant product works is the function basically asks itself, okay, if we take 10 apples out of this pool, we want K to still be 2,500. So what should Y be for X times Y equals 2,500 to be 2,500 if X is 40? With a little bit of quick maths, we get 12.5 bananas. So I will be quoted at 12.5 bananas in theory. And we can kind of see this happen on the diagram on the left. Okay, we see we have these 50 apples, bananas. If we go one way, okay, right here as it changes, it's going to go up and we see, okay, to get 10 apples, we are then quoted 12.5 bananas and that is added into the pool to keep our K constant. So that is how a constant product automated market maker works. A lot of terms there, but in the end, you kind of see how it works with apples and bananas. Yeah, we can kind of wrap DEXes up and then I'll pause for questions because DEXes are pretty cool. AMMs are really awesome design for DEXes. And there was a little bit of a Cambrian explosion in DEXes early last year. We saw a bunch of cool DEXes that built upon the classic Uniswap AMM model. And we can start with things like Balancer, where their main focus is generalizing everything. So in Uniswap, pools are 50-50 weighted, meaning that the amount of cryptocurrency that you supply in has to be equal. So the amount of ETH in the pool is also the same as the amount of Dai. Balancer went, okay, we can actually allow for an arbitrary weight here. So we allow people to create pools with arbitrary weights, arbitrary fees, arbitrary whatever. You design your AMM how you want. Curve is a very cool DEX in that it's very stablecoin centered. So it uses the same sort of AMM features that you know from before, but instead with a nice price function that is tailored towards trading stablecoins. So things like USDC, USDT, DAI, TUSD, BUSD, just yeah, everything. And finally, I'll highlight Bancor as well in the fact that their direction is in tackling impermanent loss, which is a very interesting concept. But you can just kind of understand it as a bit of risk that providers or LPs, liquidity providers in these AMM pools have to go through. And they tackle that by having both a native token and also allowing you to do things like single token exposure. So with your provider, only having to private a single token, other things like that. So they kind of tackle the risk side of things very big. So this is here to show that Uniswap isn't isn't perfection. Diversity in the DEX space is pretty insane right now. There are all sorts of DEXes out there in the world. But yeah, that is AMMs. I'm pretty sure the next slide is just questions. You can check. Yeah, cool. So I'll pause for questions again. Brian, feel free to hit me more because I'm liking your questions, and please, anyone else, questions are very much appreciated. All right. Did this sit well with your head, Brian?
Yeah, that's good.
Sweet. Yeah, okay.
Oh no, I was just gonna say that I really think DEXes are one of the most important concepts to understand when looking into DeFi. I think prior to like large scale adoption of DEXs, there was really like an irony or hypocrisy kind of in the crypto space where like I can't tell you how many times like I've like done my best to like sell crypto to someone, not like literally sell, like sell the concept of crypto to someone. I'm talking about decentralization. I'm trying to explain how like private key, public key verification works, and how it like what the like pros are of decentralization and what the results of like centralized finance have, like negative results have been. And then you sell someone on the concept of crypto and the idea of decentralization, and they're like, cool. And then they go buy a bunch of crypto on Coinbase and keep it on Coinbase, and they're like, yeah, I'm part of the decentralized ecosystem now. And then you're like, no, not really. Yeah, you just you're sold on decentralization. You like the idea and you want exposure to the space, but when you're like holding your assets on like these platforms, it's really important to understand that it's just because you're interacting with decentralized cryptocurrencies, what you're doing is not you're not really participating in a decentralized ecosystem because there's someone else holding your crypto keys. If something happens to Coinbase tomorrow, you're not like, it's still a central point of failure. Like goes down, you lose your crypto. When you're making trades or like exchanging a currency from one to another, that's still them doing it. They're still like doing KYC and like understanding who you are and then verifying that it's you and doing two-factor authentication. And it's still very much centralization in most of it, except for the fact that the blockchain transactions are decentralized. So it's this advent and like rise in popularity of decentralized exchanges is really important to taking this whole concept and this idea, the ideology of decentralized exchange or decentralization of finance or of economy in general further. So I think it's one of the most important things to internalize.
Very well said. All right, Shervin also had a question about, what about during a bear market? Do you think AMMs are sustainable? Yeah, I guess the AMMs at the level that they are at right now haven't been tested properly in what we would call a bear market. There's just been a massive bull for like the last 2 years. The upside of them is especially that, okay, because even in low liquidity, low volume situations, AMMs work a little more gracefully than order books. We are at a better place than we would be with something like an order book decentralized exchange. So personally, I do believe that they are sustainable, even in these kind of bear market conditions. We've even seen just further advancements in AMM design with stuff like Uniswap v3 with this concept of concentrated liquidities. So what we're seeing now is liquidity providers can also kind of choose what kind of price range they want to provide liquidity to a pool in. So it seems like people are doing a lot to prepare for situations like that. So I do quite believe in AMMs in that way. Yeah, sustainable is definitely a very broad term, but I kind of take it like that. Something like Uniswap, I totally don't see crashing and burning in a bear market like that. Yeah.
Yeah, I definitely agree. I do think more is left to be seen. I agree with you that it hasn't really been tested properly. But I mean, the thing with like providing liquidity, especially in the AMM model, is that when there's like, it's all based on supply and demand, right? So if there's more liquidity providers, yields like go down. And then if people like want less exposure to the asset, like for example, during a bear market and they start selling, like yields would like start going up. So it kind of self-balances in that way, but everything currently is in theory. So definitely stands, it remains to be seen.
Yep. Well said again. And Shervin, I see your thing you pasted about IMMs. I just haven't heard of these. I'll take a look and see what it looks like. But yeah, good stuff. I think we can now hop into.
Let's move on. Yeah.
Yeah, let's do it. I'll kind of finish off with lending markets. And I'll kind of speed through this so we can get to the next sections. On the next slide, once again, I'm kind of introducing the purpose for lending markets. Omkar explained this very nicely a little before as well, is the concept for lending is, okay, say you have these cryptocurrencies and perhaps you don't want to like completely give up your exposure to one to play around with the other. Like with something like a decentralized exchange, say once again, we have ETH and Dai. Maybe I don't want to just have to swap my ETH to get Dai. What if I have my ETH, I want to keep my ETH, maintain price exposure to it, where, okay, if ETH spikes, that's great for me, while still being able to play around with another cryptocurrency like Dai. And that's what lending and borrowing markets are for, especially for borrowers. They give you that purpose in exposure to other cryptocurrencies. And for lenders, you also get a very nice way, a trustless way to earn interest and get access to these interest rates, once again, without central points of failure and things like that. So we can get into the next slide. I think I actually start by just giving a couple of examples to show the diversity of the lending market right now. We have examples where it's as simple as Maker before, actually, where Maker is a very simple lending example where the only output is Dai, but you are being loaned Dai, MCD, multi-collateral Dai, by staking these collateral assets into the Dai contracts. There are also a few more complicated applications, kind of on the same level of Aave and Compound, these kind of algorithmic interest rate protocols, interest rate lending protocols. And I want to quickly go into how these are structured very quickly. So on the next slide, I have the how of DeFi lending very quickly. So in a lending market for a specific asset, let's say that we are looking at the lending, so meaning the supplying and borrowing of Dai, these all revolve around interest rates because the suppliers have to be incentivized in some way to give their cryptocurrency to the protocol to then lend out to other people. So these are interest rates, and interest rates are often set by a function of utilization, utilization being the percentage of the current market being loaned out currently. So I have an example of this on the right-hand side. And what we see is, okay, we have 80% utilization, meaning that 80% of all the crypto in this market, this Dai market, is being loaned out right now. And as you can see, the general trend is, okay, as more is being loaned out, we do need to charge higher interest rates because it is a popular market. And interest rates and these interest rate models will work in that way. As utilization goes up, the rate that you pay also goes up. Borrowers will then, so then the kind of tagline is borrowers pay interest on their crypto based off these interest rates, which is then distributed to suppliers equally. One kind of cool tidbit to understand is that the supply rate, the rate that suppliers get on their crypto, is always going to be a little bit less, decently less than the borrower rate. And this is because the amount of cryptocurrency that is supplied is greater than the amount borrowed out at all times. You never really want 100% market. So then you have to pay or distribute this paid interest by more borrowers or less borrowers to more suppliers. And because of that, okay, you get a couple percentage smaller supply rates. And of course, these lending protocols often add their own additions to their lending markets. But yeah, that's kind of the how of DeFi lending, to provide an example. But yeah, that is that, I think. We can pause for questions very quickly again, but then it's all you, Umkar.
Yeah, fulfilling my function of filling the silence while everyone thinks of questions. I think one of I think DeFi lending was one of the things that really kicked off, or was like really central to the DeFi summer last summer, with like differing yield rates here and there, differing interest rates. Like you really had people like borrowing from one place and then putting like lending here and then borrowing there and lending here and then kind of like building these. I'll talk about them later, but they were kind of referred to as money Legos that kind of strung together like a bunch of different lending protocols or liquidity providing places where you could provide liquidity together to make the most amount of yield overall as possible with this like phenomenon of yield farming that arised. Yeah, it was one of the most interesting things to learn about during last summer. And we'll get to talk about it soon.
Nice. All right, we could probably move on.
Yeah, if there are no questions, we can go to derivatives.
Let's do it.
Okay, derivatives. Yeah, this is one of the other things that was really big last summer as well. Derivatives, taking a step back from DeFi, in the traditional market, are really like sophisticated and mature tools that a lot of, especially the bigger players in the financial system, did their best to take advantage of for various different purposes that I'm going to speak about soon. So before I get into DeFi derivatives, I'll actually talk about derivatives in traditional finance, just so we understand what they are and why we need access to them. So the idea of a derivative basically is that you have this contract, and this contract, or like this agreement, has a price that is based on an underlying different asset. It derives its value from an underlying asset, hence the name derivative. So if you're looking at something and you hear that this type of asset is a derivative, you know that there is some kind of underlying asset that it derives its value from, hence the name, right? And usually these underlying assets are like stocks, bonds, commodities, currencies, crypto as well. And basically changes in the underlying value, like the value of these underlying assets, is usually what causes changes in the value of the derivative. And derivatives are mainly used for two reasons, but in the financial, or in the traditional financial system, and those are hedging risk and for speculation. Let me get into what this means with an example. So how many of you have heard of options? Or how many have heard of options? Rhetorical question, because I can't get any answers right now. Let me go back to the last slide. Sorry about that. But options, so quick side note, jargon is my biggest enemy. I hate jargon so much, but I think the words derivatives and options are better pieces of jargon because they're very self-explanatory, right? So a derivative is something that derives its underlying value from something else. And an option is basically a contract that gives you the option, or gives you the choice to buy something at a certain price or sell something at a certain price at a certain date. So an example of an option could be, right now I could purchase the option to buy Tesla stock at $600 up until the date September 1st, right? So in what case is this good for me? Let's say Tesla stock price skyrockets to like 900, right? Then on September 1st, when I'm looking at Tesla stock price 900, and then I know that I've purchased this option that allows me to buy it at 600. Is that option worth something? Yes, because I can buy immediately. Like I could buy using the options contract that I have, Tesla stock at 600, and then sell it immediately at 900 and pocket that 300 per share, right? So how could this be useful for hedging risk? Let's say you want to buy the option to sell Tesla stock at $600. And you at any time up till September 1st. And then you have a bunch of Tesla stock and it plummets to like $400. Tesla stock does that sometimes. Elon Musk tweets and stuff goes south. He's been playing around with my net worth this year, and I haven't been liking it, but it happens sometimes. So if we read September 1st, we've purchased this option to sell Tesla stock at $600, and we see that the Tesla price is now $400. Well, that's great, because if we want to exercise this option, then we can save ourselves the grief of selling at 400 and sell at 600 instead, right? And moving back from traditional finance into DeFi, we really saw, especially during DeFi summer, this emergence of DeFi derivatives as tools to really hedge risk and for speculation in the DeFi market. So later I'll talk about, I'll just give a really quick example. Later I'll talk about Compound and their governance token, which the release of their governance token during the last summer was a really big thing, and this governance token, like, its price skyrocketed. And as we know in crypto, like, whenever a bunch of money flows into something really quick, there's always a danger of a correction happening or a price retrace happening. So people were kind of worried, like, what happens if we went all in on this Compound governance token? We wanted to participate in governance in a decentralized fashion. I'll talk more about what that means later. But what if the price of Compound, the governance token, drops too far? That's when Open Finance, this is a company that was actually started by a blockchain at Berkeley alumnus. Open Finance released these options contracts on their DeFi platform that basically gave you the right, but not the obligation. So I don't have to do it if I don't want to, but it gives you the right to sell back then. So I think back then the price of comp was around 200 or 250. It gave you the right for about a couple of weeks to sell the comp token at 150. So what does this mean? This means that if you buy a bunch of Compound token and then you also bought that option, then even if Compound drops to like $70 or drops really far down, like below 150, you still have this contract that gives you the option of selling your Compound tokens at 150. So you basically protected yourself from loss below 150. So that was really a way that people got access to these like really cool, sophisticated financial tools that were able to help them hedge risk when they were getting into these risky DeFi projects. Yeah, I mean, the cool thing about DeFi derivatives in particular is they're really lowering the barriers required to get involved in these sophisticated, mature tools. Usually in traditional finance, for accessing a lot of these tools, you have to do, you have to have access to many of these exchanges, and even then, for like things like margin, you have to like get further vetted. So DeFi really provides access to many of these services and lowers barriers to them. So it's doing a lot of great stuff. Yeah, so let's talk about some so let's talk about some of the top DeFi derivative platforms. Synthetics is a really cool one. This is one of the things that I wrote about during my time at interning at the journalism company. But it's a trading platform that allows you to trade derivatives and get exposure to a lot of different assets in crypto. Like, for example, one of the things that Synthetics offered was synthetic gold. This is basically a crypto token that was a derivative. And since it's a derivative, it derives its price for some kind of underlying asset, and that underlying asset was gold. So basically, it moved up and down with the price of gold. And this is really interesting because if you've heard like the narrative of Bitcoin as digital gold, the reason that people really try to sell Bitcoin as digital gold is because the idea of using gold as a store of value is something that people have really understood for a long time. Like this idea that we need something that is true, like that is scarce to store our value because currencies inflate. That's something that people understand and people have bought into for a long time. And the problem with buying and owning gold is that there's a lot of like barriers to entry involved. Like if you're actually trying to buy physical gold, where do you store it? How do you keep it safe, et cetera, et cetera, et cetera? Well, if you just buy the Synthetics gold token, well, now the price of that token goes up and down with gold, but you don't have to deal with all the hassle of actually owning gold. So yeah, Synthetics is a really cool place that allowed trading derivatives. Another place is DYDX. This is really cool because it allowed access to perpetual futures, which basically functions like leverage. A perpetual future is a type of contract that basically tracks the price of whatever it is a perpetual future of, right? So one perpetual future contract for Bitcoin is the same price as Bitcoin. So it's kind of a way of, so buying and selling these perpetual future contracts is a way of like getting leverage on DeFi or on your crypto assets without really having to borrow from someone. And DYDX really allowed like decentralized access to this. UMA is another super cool one. It stands for Universal Market Access, and basically it enables like DeFi developers to build their own synthetic assets. So this basically allows any like developer to create a contract between two parties and make their own derivatives. That really like kind of democratizes space. Yeah, so I'll pause now for some questions. Oh, I see Ryder asked a question.
Yeah.
So Ryder's question is, who would you be selling to at such a price, or who would you be buying to at a higher price? So this is with regards to options, I'm assuming. So like when I was talking about having this derivative called options, where I am buying the right to buy or sell a certain asset at a certain price, or a security at a certain price, who is it that I get to exercise against, right? So come September 1st, or the time that my option expires, who is it that I get to say, hey, now I bought this option to buy I bought this option to buy Tesla at 900, and now it's at 600. So now I want to, or sell Tesla at 900, and now it's at 600. So I'm going to buy a bunch of Tesla and then sell at 900. Who is it that you're exercising on? So basically, when you're buying an options contract or when you're selling an options contract, there's someone on the other end who's buying or selling. It's similar to an exchange where if you're buying Bitcoin or you're selling Bitcoin, there's someone on the other end who is selling or buying, right? So what many people do is they'll like sell options or buy options as a way to hedge risk. So if you've sold an option and someone exercises it on you, that means you're the person who will now have to sell or buy it at such a price. So yeah, the answer to your question is there's always someone buying or selling on the other side, and they're the person that you will be exercising on. Okay, if there are no more questions, I can go ahead and move on to DeFi asset management. So this is similar to derivatives in that they're kind of like a tool that had limited access in traditional finance. That really like in DeFi had its barriers lowered and was seen as more accessible to a lot of different people. So asset management in DeFi has a lot of interesting standards that need to be discussed. For example, they have to be non-custodial. Asset management tools in DeFi, you really want to make sure that the underlying access to DeFi assets is not revoked when you're participating in these asset management platforms. You don't want them to be like, so the cool thing about DeFi is it's not really restricted by any like human errors or human limitations. So like there's no concept of, oh, the exchange is closed at this time, or it's I can't call my over-the-counter person to do this trade because it's closed right now, or something like that. So you really want your asset management solutions to also not be non-custodial. You want them to be composable. So this means you basically want them to be connected to a wide number of DeFi projects, and to be able to move your assets around in a lot of different places and remove friction and remove barriers. This really contrasts well to the traditional finance market, where a lot of different like derivatives or access to assets requires a lot of different accounts on different exchanges. So I'll have like Robinhood, Coinbase, Fidelity, et cetera, to get access to a lot of different things, like my stocks, my crypto, my Roth, my 401k, stuff like that. This really like does its best to DeFi asset management really does its best to reduce the number of platforms that you have to be interacting on. You want these to be automated. So a lot of things in DeFi asset management require active interaction, such as rebalancing and liquidation, and these basically happen without the user having to intervene. And basically, you want these to be globally accessible and pseudonymous. So basically, like crypto, DeFi is without borders. There's no concept of you being in a certain country. Like, for those of you who might be actively trading crypto, you might notice that you don't have access to Binance.com within the US, or FTX.com within the US, or CoinList, or a lot of these really interesting ways to participate in the crypto ecosystem that are centralized. You don't have access to a lot of these centralized platforms in the US because of US regulations, right? They really try to protect their citizens against a lot of risk. But I mean, if you want to access something, you want to access something. So DeFi is without borders. Cool. So let me talk about some top asset management platforms in the DeFi space. Zapper and Zerion are really similar. They're basically like DeFi dashboards that basically allow you to track all of your DeFi investments and your liquidity, any places that you're providing liquidity, and things like that, all in a certain centralized location. And Set protocol is actually an automated way to get access to a basket of assets. So basically what happens is they will like aggregate automated trading strategies and rebalance the market indicator. So let's say you want access to like the crypto equivalent of an ETF. Set protocol is where you can get access to these bundle assets that really like that kind of track different sectors of crypto, and like automatically rebalance, kind of analogous to an index fund or managed funds. And the cool thing about it is it's decentralized, doesn't require access to some kind of exchange. Yeah, just cool stuff. I'll pause for questions on DeFi asset management.
Good stuff, though.
Oh yeah, Nish, feel free to say anything about asset management if you want to.
No, yeah, these kind of DeFi asset management things are pretty awesome, because that's just like taking it to another level in terms of allowing more and more users to jump into DeFi, because now you don't have to worry about like exactly how does this core underlying DeFi app work, but I know that I can just go to this dashboard and like get everything I need, which is pretty cool.
But yeah. We're here for any questions though.
I think we can go ahead and move on.
Let's do it.
Cool. So now that we've kind of discussed our pillars of DeFi and really the kinds of tools that we've now been given access to, let's kind of unravel this this series of events that people commonly refer to as the DeFi summer that really took place over the last summer. Let me turn this light on so you can see my face. That took place over the course of kind of, I would say, like March through August, September-ish of 2020. where a lot of projects came out with a lot of interesting things. There were hacks, there were airdrops, there were various different things that basically shaped how DeFi evolved then and how it is today, and kind of what we value in DeFi. And all of this really started with the MakerDAO hack. So yeah, this really is what kicked off DeFi summer. This is back in early March. Maker, this is the organization that created the Dai stablecoin that we discussed earlier, and was one of the biggest players in the DeFi space, and one of the most interesting and relevant projects, especially at the time. So basically, what happened is their system got hacked, and the total value locked in Maker, and as a result, the entire DeFi space basically dropped by a really large percentage, and this kind of, I guess, depending on how you saw it, was at a really inopportune time, because on one end, it kind of like opened up the playing field to a lot of different players, because Maker was really like the biggest project in DeFi, but it also kind of coincided a little bit at some level with the stock market crash that happened back in March. So it really had, there was this whole event called Black Thursday that was related to this, that really saw drops in prices of a lot of crypto assets. But yeah, on the other hand, it really opened up the playing field to a lot of different players, and many people took advantage of this. And one of the interesting projects that kind of followed this was Balancer, who released liquidity mining. This is basically another one of the DEXes that has an automated market maker system, or an AMM system. But this basically allowed users to provide liquidity and rewarded them with their own governance tokens, right? So now you're taking your money, you're taking whatever, $1,000, $2,000 of your money, and you're providing liquidity to a lot of different pools. One of the very notable and unique things about Balancer is that when you're providing liquidity to pools, it's no longer kind of 50-50. So usually when you're providing a liquidity pool, let's say you're providing to the ETH bit, like the ETH BTC pair, like you'll divide your funds into half ETH and half BTC, and then provide to both pools. But Balancer really allowed you to provide to, as you can see over here, a lot of these interesting splits, such as like this, there was one that was just full of stable coins, and basically like gave you a lot of different options in ways that you could provide liquidity, and also incentivize people by giving them their governance token. Now governance tokens are something that I will get into a lot further when we talk about things like Compound. But basically you can think of them almost as like stock in these crypto companies. When you have a governance token, you're basically allowed to, based on how much you hold, have a say in the new developments in this platform. And this concept of being able to earn governance tokens on the platform where you're providing liquidity really was attractive to a lot of people, because now you're kind of like, you're participating in a system and you're getting incentives, but you're also getting a say in how this platform moves forward. And especially providing liquidity, especially getting governance tokens by providing liquidity, was a decentralized way of distributing these tokens. And many projects followed suit. Soon after, Compound released their governance token. This is a token that I was talking about earlier that Open Finance created an option for. But this governance token was basically distributed via liquidity mining also on the platform. And it, again, really allows users to be involved in how the platform moves forward. A quick kind of description of how governance tokens work. Governance token holders are allowed to basically make proposals on changes to the system or changes to the protocol, and if there's someone else who agrees with those changes, then they can stake their tokens on your proposal. Based on staking, there's a process of vetting, a process of approvals, and then people will vote on these proposals, and based on that vote, they'll either be executed or not executed. And this is just a really cool way for it's like taking decentralization to the next level. First, you have the level of having a cryptocurrency, a currency that is decentralized, where the transaction verification is decentralized. Then you have the next level, in my opinion, which is creating platforms like decentralized exchanges, which is where you're able to keep your tokens in decentralized custody solutions, and then also trade them in a way that is decentralized and not overseen by a company, and where transactions are not verified by a central authority. And then you almost have the next level, where those platforms and how they change and what decisions they make, those decisions are also decentralized. So this concept of distributing governance tokens and distributing the right to have a say on where these platforms go, that kind of was like the next level of decentralization. And people saw their ability to acquire this governance token and have a say in how a platform does things. It was really an attractive prospect that brought a lot of people. So Compound, I believe their total value locked skyrocket or like doubled almost in like 3 days after launching their governance token. So this is really this concept of governance tokens really was a contributing factor to how DeFi moved forward. One of the problems though was that there were a lot of like large VC companies and firms that did their best to acquire as much governance token as possible, and then what kind of started happening was a lot of these governance proposals started being like kind of dictated by large companies, which is kind of the opposite of what we wanted to happen. But yeah, that's something that we had to be dealt with. Moving forward, we have Yearn Finance. So Yearn Finance was a project that was kind of started by this developer named Andre Cronje. He kind of has a decent amount of I want to say fame, but maybe notoriety is a bit more apt in the DeFi and the crypto space. The kind of saying that he goes by is "I test in prod," which basically means like I test my code in production. So I don't test my code first. I deploy my code, and when it's in production, that's when maybe bugs will be seen. And Yearn Finance was really seen as a gateway to all of DeFi. What basically happened, what Yearn Finance basically allowed people to do was have their yield, the yield that they earned from being a liquidity provider to these liquidity pools or to these AMM protocols, to have that yield be optimized. So for example, if you want to provide to stablecoin pools or some kind of liquidity pool with a certain token, Yearn would basically go around and do its best to find which pools are currently providing the best yield, and then it would kind of like reallocate its assets every time someone would either withdraw or add to the pool. And then basically you get a token that represents your stake in the pool, and that could also be reinvested into other platforms. So Yearn kind of really like was one of those projects that plugged everything together. And it's definitely one of those connecting blocks in these money Legos. So people would put their money in a certain project or in Yearn, and then get their tokens from Yearn, put that in somewhere else. and do their best to maximize their yield. And one of those projects was, Curve Finance. So Curve Finance is a decentralized exchange that really focused on swapping stablecoins and made it a lot more efficient. This was super helpful for the purposes of slippage. One of the biggest problems with exchanges in general, and especially decentralized exchanges, was this idea of slippage that when I initiate a trade, the price at which my trade will execute will actually be a little bit different from what I initially clicked on, because there's low liquidity, and this would especially happen within larger orders. So like if I'm trying to sell like 10,000 ETH, my first few ETH would be sold at like a really good price, and then like the later ETH would be sold like at like worse and worse prices, because you're really like taking a bite out of the liquidity that exists on the protocol. So you'd experience a lot of slippage on the price. And the thing that Curve Finance did best is it tried to minimize the slippage that you experience, especially on stable coins, and then between similarly priced assets. So you can see over here like Wrap BTC or Ren BTC or like BTC itself. These assets that are all supposed to have the same price, to interact with different DeFi protocols, you'd need to kind of trade back and forth between them. And what things like Uniswap would do is they would go from, let's say you want to trade like stablecoin A to stablecoin B. What they would do is they would trade stablecoin A to ETH, because ETH was what was central for Uniswap, and then trade ETH for stablecoin B. And that really resulted in a lot of slippage. So you'd see yourself putting in $500 and getting out like $488 because of all the transaction fees and the slippage that happened a bit in between. And Curve really did its best to minimize this and allow people to trade directly between stablecoins. It also gave people a lot of yield, and given this yield fluctuation, it was one of those money Legos that you kind of plugged in with other things like Urine Finance. Like people would have transactions on Urine, take out what they got from Urine, and then put that on Curve, and then overall in the system, like basically create a yield generating machine that gave them as many returns as possible, which was a super interesting kind of phenomenon that happened in the DeFi summer. Moving forward from that, we have Yam Finance. This was kind of one of the more unfortunate events that happened during the DeFi summer. This basically allowed people to, so this is one of the DeFi protocols that basically blew up really quick, and then kind of lost all of its money because of probably under auditing or lack of auditing for the smart contract. So what basically happened was people saw it as a new and shiny project, a way to make more money, and then the price skyrocketed, or the total value lock skyrocketed to about 63 million, and then back down to zero within the course of 2 days. And this is really described as the perfect pump and dump setup. And people really lost a lot of money on it. And the real significance of Yam Finance and the Yam Finance pump and dump event and what happened was really a change in people's sentiments. Yam Finance was really one of the catalysts towards the cool down of DeFi summer. People starting to get jaded, people starting to understand that there's like a really high emphasis, that there should be a really high emphasis placed on smart contract auditing. Actually, one of the things that I forgot to discuss with Urine Finance earlier was that people realized that in the beginning of Urine Finance, it gained a lot of traction and got like hundreds of millions of dollars of value locked. And people realized a couple of days in that based on the way that the smart contract is, Andre had access to the value locked in Urine, so he could have kind of just taken the hundreds of millions of dollars that were there. So to kind of increase trust in his own product, as a show of goodwill, he kind of he burnt the multi-sig keys that gave him access to that, that really put a lot of people's fears to rest. And Yam Finance was an example of something that had a similar avenue for losing funds, but that lacked the goodwill of the events involved in Yearn Finance. So it really on one hand reduced a lot of trust in the DeFi space, but also gave people something to focus on, and kind of cemented in people's minds the importance of focusing on auditing. Yeah, moving forward, another of the events that had a good amount of effect on the events of DeFi summer and how the DeFi space shaped today is the Uniswap token drop. So following a lot of these projects that had governance tokens like Compound and Balancer, Uniswap, in kind of a way to stick to their guns of decentralization, they basically had this token drop where 400 uni tokens were airdropped to all of the 16,000 users, or all the 16,000 wallets that had transacted on Uniswap in the past. This is kind of thought of as a DeFi stimulus check at the time, and it was really their way of saying, hey, we are a decentralized platform, and to show that we're a decentralized platform, we want to take our governance token and distribute it among everyone who has transacted on the system. And this is actually one of the most lucrative, I think, airdrops that has ever happened in the past. It started out, I think the Uni token reached it seems up to $7, and then what kind of happened was right now this 400 Uni airdrop is worth, I think, about $12,000 because each Uni token now is around 30. But basically what happened at the time was kind of as a result of events such as the Yam Finance event, where people lost trust in DeFi. Many of the users really just took this as an excuse to dump on the market, to take the funds that they got from this airdrop, and then to take the profit and to exit DeFi as soon as possible. And this drop of the Uni token price right after the Uni drop really was hard proof of the fact that we were moving on from DeFi summer. So then we have this idea of DeFi fall that basically happened post DeFi summer as a result of increase in DeFi scams among users. During DeFi summer, there was basically DeFi really took center stage for crypto. People were talking about decentralized protocols more than anything else. During my time at working in crypto journalism, all of the articles that I wrote were about synthetics, open finance, Compound, and DeFi protocols that people were getting involved in, yield farming, and as we know, as I mentioned earlier, in crypto, when things gain a lot of traction and a lot of value fast, especially when people get burned, you usually see a cool down, and that's exactly what happened with DeFi summer. And yeah. And a quick thing to mention before we actually move to questions is that DeFi actually has seen a lot of changes since then. I think Nish will talk about this soon, but for example, the Binance Smart Chain really provided an alternative entire ecosystem for people to interact with DeFi protocols. One of the one of the things that contributed to the cool down of DeFi was the spike of ETH gas prices. So you found that people had to like pay like tens, sometimes hundreds of dollars in gas fees just to interact with these protocols. So if you're playing with like a couple hundred or $1,000 and want to interact with these DeFi protocols, it really like stops making a lot of sense when per transaction you have to pay that much amount of things, that much gas fees. And Binance Smart Chain really really showed up as a portrayed alternative to this. Binance, the smart chain had a certain number, like a certain specified number of validators that had higher barriers of entry to be validators. So the number of validators was very limited. So it was definitely a bit more centralized than the Ethereum kind of DeFi ecosystem was. But as a result, it was just a lot faster in transactions and a lot lower gas fees. So it just provided an alternative avenue for people to interact with really cool DeFi protocols.
Perfect. Yeah, very well said. We can pause for a second for any questions from DeFi Summer and the storytelling. It's kind of fun to learn like the real stories and timeline behind things like DeFi. We see like, oh, these cool things have popped up, but this really shows like the speed to which it popped up and just the crazy mania that it was. When YAM started popping off like in the end of the summer, it was an insane period of time, just 2 days, where people were like, wow, we're just gonna mess around and just experiment with this new financial tool, and lessons came out of that about how to manage your DeFi protocols. So it's all very cool. It just kind of highlights the experimental aspect of it. But yeah.
Yeah, I think you said that really well. I think it was a very interesting time to live through in a interesting ecosystem to interact with. It was really a lot of growing pains that it faced, and I guess everyone made a lot of money and lost a lot of money, and most importantly learned a lot of lessons about what they want from decentralized products in the future, and those are really what have been informing changes and the movement of a capital towards where interest lies in the DeFi space.
Yeah. All right, we can take it into the next sections. I think next, yeah, I'm gonna next part's maybe take like 5-10 minutes. But I'd like to highlight a little bit about what DeFi looks like as a universe right now, and also what's next for DeFi. What are the trends to look forward to? So a little bit of alpha in concept over there. But yeah, if we get into the diversity section, this is very quick. I just wanted to emphasize just through a couple of diagrams. I'm quick to go to the next slide. Just and then next, just how big DeFi is. We've mentioned maybe 5 or 10 different projects, but this list right here is just a subset of the people building around DeFi, trying different things in different sort of categories. It's kind of hard to read there, but you see the categories we've talked about, like derivatives and trading and lending and stablecoins. And even more have popped up since this has come out. I think this is honestly a pretty old diagram when you think about it at the end. We can go to the next slide as well. I think it's just another good old map. But yeah, anyways, we can go to the next slide as well, kind of highlighting the diversity in other ways. We now also have diversity in the management of these DeFi protocols. For something like Compound, where we talked about them doing decentralized governance, we see that Compound is now technically controlled and voted on by over 1,200 voting addresses. It has grown significantly since then. And now Blockchain at Berkeley, our organization, is even part of that. We are a delegate and a governor of Compound, and I'll talk a little bit about that in our future of DeFi thing. But it's really cool. You see this diversity of people even controlling these DeFi protocols. So now it's not just the core team, which is pretty cool. The next slide also shows diversity in development. Kind of the way that we are developing these DeFi products. Okay, we see this is a screenshot from Coin. These guys who do a bunch of cool grants for DeFi companies and DeFi developers. We're seeing how many developers are around here in DeFi and making it a really exciting place to be. And even personally, for me as a software engineer, I look around and I'm like, yeah, this is probably the coolest place to be at right now. So it's very cool. And this is a very short section, so I'll kind of just lead us into the future of DeFi one, so you can just skip a few slides, Omkar. I think, yeah, we can just go into the future of DeFi. And I'll just talk to you for a second about what's next. And in just the last few months, we've had a lot happen in DeFi. Something you guys have probably caught on is the re-rise of NFTs, and just the hype cycle that we're in for that. So there have been questions around, okay, what do NFTs mean for DeFi? And there's a lot that they can mean. We have projects deploying on layer 2 to scale. Layer 2, I'll talk about in a little bit. Layer 2 and cross-chain, left and right. So we talked about Binance Smart Chain, and the kind of overall movement to focusing on layer 2 and cross-chain deployment is very cool and very 2021. Part of that cross-chain cycle was, of course, the Binance Smart Chain hype cycle, which was pretty crazy. Going on, there were a few waves of these things called algorithmic stablecoins, which is highlighted by Fei protocols recent few weeks. They are another one of these algorithmic coins that has gone through a lot in the last few weeks. So I would totally search up on something like Twitter or online Fei protocol and reading up on their blogs or just what people are saying on Twitter. There's been a lot going on. So give me a nice little experiment to learn about what that's all about. And of course, on the kind of protocol layer 1, we have seen cool things like us taking the first step in Ethereum 2.0's release for further scaling on the Ethereum blockchain, which is one of DeFi's biggest homes. And much more has happened in the last few months. So even though DeFi is past its manic summer, the growth is hardly over. And I will just highlight to you guys in the next few slides a few trends to watch out for and a few trends to really bring DeFi to the masses. So we can kind of move on to the next one. Some trends to watch for. The first one is kind of aggregation all the way up. We've kind of seen a couple layers of this, but the overall question is, how do we bring DeFi to the masses? And one answer is make it feel like they're barely touching a blockchain. They're barely touching things like Uniswap, where you have to understand the risks of trading at a very, very deep level. And you have to really understand almost how an AMM works. We wanted to abstract things like that. So for example, we have things like DEX aggregators. So now aggregators will look at different DEXes and give you a better price, the best price across these different DEXes. We have these smart investment managers. So Yearn is a very big name in DeFi, and they basically allow you to deposit your crypto and they will smartly invest it in any which way. So we have these cool smart investment managers where now that's something I use because I'm like, okay, I can't afford to just be trading all the time. I'll let these guys do it. And many other things like that. That's been a very key trend right now. There are hopes that even in the end, it'll feel almost just like you are taking your USD or US dollars, dropping it into some platform, but then in the end, you will be using decentralized finance. It's a very cool way to sort of visualize this kind of ending up being aggregated. But yeah, let's move on to the next one. And the next slide is about privacy. This is a cool kind of little trend that I'd like to highlight as well, because to many people, privacy can be DeFi's core innovation. And the problem is that it's not here yet right now. In many of these public smart contract blockchains, everything is tied to an address, and there are crazy stories of miners because they know and can see what you're trading, front running you or trading right before you do to kind of manipulate prices and for them to take profit and for you to lose. It's a crazy type of thing, and there's this really cool article. If you just search up like Ethereum Dark Forest, that article will pop up, and it's very cool. So that's a great read. Just to kind of mention this, but at the same time, progress is being made here. Things like shielded transactions and private swaps and things like that, often powered by zero knowledge technology. are really cool things to kind of Google and learn about for how DeFi is looking to improve on the privacy aspect. Next up, I believe I have Omkar. You go to the next one. Oh yeah, governance. This is a fun one. So we've kind of talked about the decentralized execution of these financial products. Okay, when I'm using this financial product in DeFi, I know that everything's going through this auditable smart contract. Okay, cool. But how about everything? How about the way that updates are pushed out to a contract, the way that the entire community or protocol evolves as a whole? Things like that are now being handed off from these protocols and teams themselves, which you'd have to build them in the first place, to now entire communities. So now, yeah, and so for example, Aave was something like this, who last fall literally handed over the keys to which give them the ability to upgrade their smart contracts to the community. So a vote has to happen for anything to change to Aave, which is very, very brave and very bold. Governance is definitely an experiment that Blockchain at Berkeley is lucky enough to be part of. Last December, or in December, we were delegated enough to be a top 10 vote holder on both Compound and Uniswap. So we, as a regular voter, we vote on proposals. We are working to make proposals to continue to change and improve these DeFi protocols. And it's really cool how they've built up these communities, which will include the core team of developers for things like Uniswap, but also have very heavy active community members who we've had the kind of privilege to work with, which is very cool. So one of the most modern and cool things going on in DeFi right now is this wave of decentralized governance. And finally, I talk about scalability. And this is the biggest thing right now. Like Omkar mentioned, anytime in the last 6 months, you couldn't enter or exit a trade position without spending, tens of dollars. One time I tried to get out of a really complex one and I had to pay $100. Like, man, I'm a college student. I can't do that. I can't do that like at all. So how do you bring DeFi to the masses? You scale such that things like high fees don't have to exist. So there are kind of two frontiers for scalability. We talked about this last week, which is kind of nice. We talked about L1 scalability. So for something like Ethereum, where DeFi is primarily right now, we have things like Ethereum 2.0 to look forward to, which is actually coming, which is very cool. And then on another side note, an important note, like we've mentioned, DeFi is not just Ethereum. DeFi exists on all sorts of other L1s, other base layer chains. We've heard about the Binance chain. Other popular ones are Solana, Near, Polkadot is a really big one popping off for DeFi right now. Even companies in our startup accelerator were based on Polkadot and they were doing DeFi. So we had DeFi Polkadot companies in the accelerator last year, Omkar and I. So right now, moving to different chains has also been another pattern, which is very interesting. And then on the L2 side of things, especially on Ethereum, L2 has been the way that projects have turned to scale. It's really cool because I got to lecture about this last week. So things like rollups are being used right now to be an L2 for many of these DeFi applications. So things like Uniswap is moving to the Optimism rollup, or things like Aave working on side chains, all sorts of other things like that. Very cool stuff. And that is their short-term scalability solution, because now you can trade on things like Uniswap on L2 for a fraction of a cent, which is amazing and kind of mind-blowing. So yeah, that's kind of the overlook for this sort of stuff. So that is what I see as the future of DeFi. I just have one final slide, Omkar, if we can go here. We'll take questions at the end. And my final note to you is DeFi is awesome. I hope this lecture has been more than enough to show that to you. And Omkar and I are here to answer any questions and talk to you continuously, as long as you'd like, about what is DeFi, how you can continue to dive into DeFi, and perhaps find your way in here and working here. So it's very, very fun, very cool topic. Yeah, I hope you all enjoyed. We'll both take your final questions.
Great lecture, you guys. Really good stuff.
Thank you.
Announcement to everyone else. Sorry, I know there's only 10 people here right now, but hopefully people will see this on the recording. Nate and I have been getting a lot of emails with people being worried about their quiz scores and if they're going to pass the class. And so we want to make it very, very clear that we want every single person to pass this class. Like we really hope we don't have to fail anyone this semester. So as long as you are doing the quizzes and you're doing the discussion posts and you show like a decent amount of effort on your final paper, you will pass the class. So don't worry if like you are bombing a couple of quizzes. The point of this class is to learn. And so if we see that you're making like an effort to learn about blockchain, and we see you showing up and stuff, then you'll pass the class. So please don't worry about that. And yeah, I think if there are no questions, that's it for this lecture.